Subscribe to my channel Report Stock.
Okay, let's dive into something really interesting today. Imagine this. A company. It's hitting its production targets, really bringing costs down, and even, moving forward strongly with a major expansion.
Sounds like they're firing on all cylinders, right? A classic success story.
Exactly. But then you look at their revenue, and it's just plummeted. So what's going on? I mean, how can a company be doing so well operationally, but see such a steep drop in sales revenue?
Well, it's fascinating, isn't it? And I think what it shows is that it's not always about just maximizing sales right here, right now. Sometimes what seems like a really counterintuitive move can actually be very disciplined, very strategic.
Especially in a volatile market.
Precisely,
Yeah.
particularly in this lithium market we've been seeing.
Right. And that's what we're doing today. A deep dive into the latest Q2 2025 results from Sigma Lithium. We'll look at how they boosted lithium concentrate production up by an impressive 38% year on year.
And how they consistently kept costs, both operating and all-in sustaining costs, way below their own targets.
But here's where it gets really interesting, like you said. Despite those operational wins, their gross sales revenue down over 60% compared to Q2 last year.
A huge drop.
So our mission for you today is to cut through those numbers, really understand the why behind this apparent paradox. We want to uncover the surprising strategic choices they're making.
And figure out what it all means for the future of lithium and, by extension, electric vehicles.
Okay, so given this puzzle, let's start with what Sigma Lithium is clearly getting right, their production. Q2 2025, they had exceptionally strong performance.
Yeah, they generated 68,368 tons of lithium oxide concentrate.
Which, as I mentioned, is a big jump, right? 38% year on year.
Correct. And it was actually slightly above their quarterly target of 67,500 tons.
So they're not just meeting expectations, they're exceeding them slightly on the production side.
Exactly. And this output, it's all coming from their Grota do Cirilo operation down in Brazil. It definitely puts them comfortably on track for their annual production goal.
Which is 270,000 tons for the year.
That's the one. It really shows strong operational capability.
And that capability, that efficiency, it seems to carry over into their costs too, doesn't it? Because the cost reduction numbers are, well, they're pretty noteworthy.
They really are. If you look at their CIF China cash operating costs, basically, what it costs to produce and ship it to China.
Including insurance, freight, all that.
Right. That came in really lean in $442 per ton in Q2.
And their target was $500 a ton.
Yeah, so that's a full 12% below target. And it's even down 3% from Q1. So costs are moving in the right direction.
Okay, and what about the broader picture, the all-in sustaining costs, the AISC?
Similar story there. Really impressive control. AISC gives you that sort of total picture, including ongoing capital needs. It came in at $594 per ton.
Which is, what, 10% below their target?
10% below their $660 target, yeah. And also down 4% from the first quarter.
So how are they achieving these kinds of reductions?
Well, it seems to be a mix of things. Economies of scale, definitely producing more, help spread fixed costs. Their plant gate costs have been stable. And they've apparently got very efficient freight and port operations going on.
Okay, strong on production, strong on cost control. But I did notice a little nuance in those cost figures. You probably saw it too. While the total cost of sales went down significantly, 20% year over year, 31% quarter over quarter.
Which makes sense if they sold less.
Right. But the cost of sales per ton actually averaged $584. And that figure was slightly up year over year and quarter over quarter. How does that work? Seems a bit backward.
Yeah, that does seem counterintuitive at first glance. But it actually makes perfect sense when you factor in their strategy.
Okay.
Think about it.
Yeah.
If you're deliberately selling less product, your fixed costs, the ones you have regardless of sales volume, get spread across fewer tons sold.
I see. So even if total spending is down, the cost attributed to each ton that they actually sold can look higher.
Exactly. And that brings us right to the heart of it, doesn't it? The reason for those plunging revenues. So let's tackle that head on. These dramatic drops, revenue down 60%, sales volumes down significantly too, about 23% year on year and 34% quarter on quarter. What's the official line? Was this, a bad quarter, a misstep?
No, not according to them. It wasn't a misstep at all. In fact, they're quite explicit about it. This was and I'm quoting here, a disciplined commercial strategy.
Disciplined commercial strategy.
Meaning they chose to temporarily hold back product, to not sell it, even though they'd produced it. They did this specifically during periods when lithium prices were, well, extremely volatile.
Wow, that's quite a move to just sit on inventory when prices are shaky. That takes some nerve, doesn't it?
Or maybe a strong belief in where prices are heading.
It certainly speaks volumes about their confidence, yeah. Confidence in the long-term value of their lithium. The whole point, they say, was to preserve their pricing power.
And protect long-term margins.
Exactly. Don't sell cheap now if you think you can get a better price later. And you see this reflected starkly in the average price they did get for the tons they sold.
Okay, what was that figure?
Just $524 per ton, which, when you compare it, is a 51% decrease from the year before and 32% down from Q1.
Ouch. But that was the consequence of their strategy, or perhaps the justification for it.
Both, really. It shows why they held back prices were low, and it's the result of only selling some limited volume, potentially under less favorable terms or existing contracts, while holding the rest back. Their CEO, Anna Cabral, framed it as demonstrating their ability to, quote, create value through market cycles.
So it's about riding out the storm, not just selling into it.
That seems to be the philosophy. Don't just sell because you can produce. Sell when the market properly values what you've produced.
And, okay, this deliberate withholding, this strategy, it obviously flows straight through to the bottom line in the financial report, right?
Absolutely. You see it immediately. They reported an EBITDA that's earnings before interest, taxes, depreciation, amortization, sort of a proxy for operational cash flow.
Right.
That was negative $16.876 million. And the net income was also negative $18.857 million.
So losses for the quarter.
Yes. And these figures are a direct reflection of that choice, prioritizing future pricing over selling everything in Q2.
Okay, and what about their cash situation? Holding inventory and booking losses must impact their liquidity.
It did. Looking at their balance sheet, cash and cash equivalents were down to $15.113 million at the end of June.
That sounds like quite a drop from before.
It is. It's down 80% compared to Q2 of last year and down 51% just from the end of Q1 this year.
Wow. So what's driving that decrease? Just the operational costs while revenue is low?
That's the main driver, yes.
Yeah.
Paying for operations while deliberately limiting sales. But there was another factor, too. They proactively paid down some debt.
Oh, okay. Big leveraging.
Exactly. They reduced their short-term trade finance lines by about $6 million during the quarter.
So even while managing this tricky sales strategy and cash burn, they were also actively managing their debt.
Seems so. It suggests they're trying to keep the balance sheet tidy, not just reacting to the market conditions, but also proactively managing their finances.
Okay, so they're navigating the present volatility, but what about the future? This company isn't just sitting still, are they? Let's talk growth, the Phase 2 expansion.
Right, that's a huge part of their story. They're not just managing Q2, they're building for much bigger output. They've made quite a bit of progress on this Phase 2 expansion.
What does that involve?
Well, they've completed key site preparation work, and they're moving ahead with their procurement strategy, getting the orders in for critical equipment.
And this Phase 2, it's a pretty significant step up, isn't it?
Oh, absolutely. It's set to be a game changer for them. They expect to start ramping it up in 2026, and the plan is to effectively double their nameplate capacity.
Double. To what level?
Up to 520,000 tons per year. That means adding another 250,000 tons per year of their 5.5% green lithium concentrate.
That's a massive increase. And what's interesting is how they're positioned commercially as they head towards this expansion.
How so?
Well, currently, 100% of their production is uncommitted. They don't have existing long-term contracts locking up all their future output. How does that give them an edge, especially when they need to fund Phase 2?
That's a really significant strategic advantage, potentially. It means they're not tied down by, say, older agreements signed when prices might have been lower.
They have a clean slate, commercially speaking.
Pretty much. They're actively looking at options now, things like long-term prepayment deals or off-take agreements, which are basically contracts to supply future production.
And they can use these to fund Phase 2.
That's the idea, to optimize their capital structure, get funding sorted for the expansion.
Yeah.
And because they're uncommitted, they can negotiate these deals now from a position of flexibility, presumably aiming for the best possible terms in what they hope will be a stronger market environment.
It's like keeping your options open until the right moment.
Exactly. Maximum flexibility.
And tied into this long-term view, this market positioning, their whole quintuple zero green lithium identity. That's not just branding, is it? How important is that sustainability angle in this long game they seem to be playing?
I think it's crucial, absolutely crucial. In today's market, especially for EV battery materials, buyers, particularly the big automakers, are intensely focused on ESG, environmental, social, governance factors.
Right.
So Sigma's quintuple zero claim, which means net zero carbon, no duty power, no potable water use, no toxic chemicals, and importantly, zero tailings dams.
Which is a big environmental concern with mining.
A huge one.
Mhm.
This commitment isn't just, good PR. It's a genuine competitive differentiator. It could allow them to command a premium price or secure preferential deals with those major downstream players who need clean supply chains.
So the green aspect is potentially worth real money in the long run.
Potentially, yes. It aligns with where the whole EV industry is heading. It builds long-term value.
And sticking with that theme of responsibility, they also highlighted their safety record recently.
Yes, they celebrated 2 years without any accidents or fatalities, which, for any major industrial operation, especially one that's been ramping up like they have, is a significant achievement. It speaks to high operational standards.
Okay, so let's try and wrap this up. What does this all mean for you listening in? We've seen Sigma Lithium, a company that's, well, really performing strongly on the operational front. Costs down, production up, big expansion plans.
Firing on all cylinders operationally, as we said at the start.
Right, but they made this very deliberate, very conscious choice to step back from the market, to sacrifice that immediate revenue, all for a longer-term strategic reason.
And I think this really raises a fundamental question, doesn't it? Particularly for industries like lithium that are so critical for the energy transition for EVs.
Yeah.
How do these companies balance the immediate financial pressures, the quarterly results everyone watches, with that longer-term goal, positioning themselves strategically, creating value over cycles?
It's a balancing act.
It is. And Sigma Lithium's approach here, it suggests a really deep belief in the fundamental value of their product, and maybe a willingness to ride out the current price volatility to get, better returns down the road.
It's definitely playing the long game.
Absolutely.
And this deep dive, hopefully, it shows you that a company's financial report, it's not just numbers on a page for one quarter. It's really a window, isn't it? A window into their strategic thinking.
How they're navigating these really complex, shifting global markets. It's like a high-stakes chess match playing out.
Totally. So, you've now got some insight into how a company might deliberately choose future pricing power over today's sales figures and what that could mean for such a critical industry. So the thought to leave you with is, what really stands out to you about this kind of bold strategy? And maybe, how might it influence other players, other companies up and down the EV supply chain?
Something to chew on.
Definitely something to ponder until our next deep dive.
Subscribe to my channel Report Stock.